G'day and welcome to this video. My name is Robert Gowdy from Consulting Private Wealth, and today was just a bit of a follow-up from the previous video in relation to valuations of the markets and what the ordinary investor can do to take advantage of the crash that we're currently seeing at the moment, and obviously the big downward percentage drop that we've seen. What opportunities are there for people, and how can you take advantage? Now, obviously very well aware that not everyone has ready cash just sitting beside to invest into the market, but a lot of people do have their retirement assets, their superannuation funds, and when we start to have a look at the asset allocation of those funds, that will give us a bit of a guide, or give you a guide to know whether you can take advantage of what's happening at the moment. So I'll just bring up our standard asset allocations, and hopefully you can see this clearly enough. So essentially we work with five separate asset allocations from obviously 1 to 5. Number 5 being the obviously most aggressive option, and the number 1 being the most conservative. So you can see here it's around 27% growth assets, compared to up here we've got 94% in growth. Now, of course, you can see here the level of volatility between the two. 1 in every 20 years, you can see -4%, where over here, it's nearly 30%. So to get the higher rate of return, which you can see, actually my mouse there, so you can see here, the rate of return compared to the conservative asset is considerably different. To get that extra return, you need to put up with obviously a much higher level of volatility, as you can see here. So the way that we allocate risk profiles to clients is we go through a risk profile questionnaire. The industry funds have plenty of these on their websites, but generally we find that 80% of people sort of land around balanced, a 60-40 split. Now, if you're sitting in that area, it means you've still got 40% of your investments conservatively invested in cash and fixed interest and conservative assets that in this low interest rate environment will not perform terribly much. So there is a strategy where you could potentially change from balanced or moderate, they've all got different names, and move up a level to sort of a 75-25 or 80% growth and 20% conservative. So that is essentially moving assets from the conservative area up into the growth area while the markets are down. So that is something that is absolutely appropriate to do, but you need to understand that when you're moving assets from conservative, which generally don't go far, they won't give you much of return and they won't grow, into the share market, you're going to have to put up with more volatility. And that's where these areas here, the 1 in 20, the 1 in 50, the 1 in 6 years, the more growth assets that you have, the greater the amount of volatility that you'll get. But as I often say, people need to understand what their investment time frame is. People that retire at 60, I class them as a 30-year investor. So you may have retired, but you've still got 30 years worth of investing to go. So even at those ages, at retirement, please don't retire your money. You can retire physically, but don't retire your money. It's got to last for decades to come. So that's something that people can do now. I would highly recommend that you understand the risk, your risk profile, and understanding that taking on more growth assets will give you a higher return over the longer term, but will expose you to short-term volatility. That's clear in what's happened with the coronavirus share market crash. So there is an opportunity there. Please talk to your financial advisor. Please do risk profile questionnaires. Understand the way that you're invested now to understand where there's an opportunity. Thank you for listening. Appreciate your time, and please subscribe to the channel if you haven't already done so, and we'll catch you next time. See ya.